So who was right? Let's bring in our Fox panel. Pat Powell is from Powell Financial. She is here with us. Peter Schiff is actually in New York now to face off one-on-one with the human beings that are also on the panel. He's author of this book, Crash Proof. Victoria Barrett, senior editor of Forbes magazine, and Gary Kaltbaum is from GaryK.com. Good to see you all. Peter Schiff, your views, I think, contrast more sharply with the president's than anybody's. Tell us why he's wrong.
Well, of course, he has an agenda. He's the president. He's trying to talk up the economy. That's all he ever does. And he tries to say that everything is great because the statistics say they're great. He claims there's no inflation because the CPI says there's no inflation. Or he says the economy is growing because their GDP figures show that. But the reality is very different. I think we're already in a recession. I think the recession is getting worse. Inflation is not under control. Inflation is already high and getting more pervasive. And so the economy is in trouble. I mean, if it wasn't in trouble, why would we be talking about a 50 basis point rate cut? Why would the Fed be cutting rates?
You're here in person. You can look at us.
Oh, they told me to look at that camera.
No. You can look at us. It's all right.
They told me to look at the camera. But, I mean, why would the Federal Reserve be cutting rates if the economy were really growing as fast as the government claims?
Yeah, and the president, Gary Kaltbaum, also saying the economy is going to slow down, and this is exactly the time not to raise taxes. So which is it? Things are great or things aren't so great?
Well, first off, it is the worst time to raise taxes. But I got to tell you,
Is there ever a good time, Gary?
No, not really. And I got to tell you, I've been carrying the water for President Bush for a while because he had the facts behind him. But I got to tell you, I don't think he has the facts behind him anymore. And you can sit there and talk low inflation from government stats, but every bit of stuff that the American consumer buys right now is going way up in price. And if he wants to talk about underpinnings, in that statement, he forgot to mention almost a depression in the housing market and very restrictive lending out there to make things any better. So I am not in his camp right now. And I have to tell you, to add to what Peter said, if things were so fine, why is this administration trying to come out with price controls in the mortgage market for the interest rates, which I think is absolutely crazy, and we could talk about that also.
That's the first time I've heard the phrase price controls for what the administration has planned for the mortgage mess.
Boy, that's pretty scary, isn't it? The last time, wasn't it Nixon who did the price controls, and that was not exactly a success, was it?
Yeah.
You know, we are in a slowing economy, and I think that that's really what you have to pay attention to. We're in a slowing economy to the extent that the credit crunch and or the deteriorating subprime lending pushes us further along. It doesn't take that much to dip us into recession. But recession is not a disaster. I went back and looked at the last 12 recessions that we've had, and these are all post-Great Depression. Of those, 9 of the 12 had a duration from peak to trough of between 6 months and 11 months. So it is not a disaster.
Sure,
it is not the depression that Gary is referring to. It's obviously there are some problems in housing, and people who have gotten caught up are feeling a great deal of pain. But you don't want to take that pain and put it on the rest of the economy. The majority of us are doing fine. The majority of people out there are doing fine. But we might tip. I think we're slowing. I'm not sure we're going to tip. I don't think so. But there's a risk here.
Victoria, what are you thinking about this?
Well, the interesting thing about recessions is that they're becoming much shorter in duration. So, to echo what's just been said, even if we are in a recession or headed for one, it will be a short period of time, and most people probably won't notice. The key here is unemployment. And so far, even though we've had all this financial turmoil and high oil prices, unemployment has stayed relatively low. And what concerns me is in the state of California, we've seen unemployment creep up. And is that a sign of things to come? And are folks going to start doing more layoffs? That could be really dangerous.
I want to go back to the word underpinnings that was used. The thing for me is, if I've studied markets and the economy going back many years, is economies just don't top out in one fell swoop. They top out over time. And all I am letting you know, for the last 2 years, the underpinnings have been getting less and less helpful to the economy, and I think we're starting to see a little bit of the tipping process. I didn't say anything about a depression. I said housing is heading there. My biggest issue is I don't see anybody doing anything that's going to fix things. Lower interest rates, that's not going to do the trick. Markets over time are going to do the trick. I just hope they don't do too much to really cause problems.
Peter, let me ask you something I've always wanted to ask. When was the last time the economy was in good shape by your standards?
Well, it's been a long time. These previous previous recessions that Pat mentioned.
Can you mention an era or a time?
Let me just finish this point. It's an important one. The reason that past recessions were so shallow.
My question was important,
yes,
too.
but the reason that past recessions were so shallow is because the Fed was able to minimize them through monetary policy. That created this gigantic mess that we have now. If we had had more deep recessions in the past, the one we're about to enter, or that we've already entered, wouldn't be as gigantic as it's going to be. The Fed cannot save us from this anymore. There's no more, they can't pull any rabbits out of the hat.
So when were we doing everything right?
Well, look, we had a great economy during the Industrial Revolution. We had a great economy.
We have to go back to the Industrial Revolution?
We had a great economy probably following World War II. But no, unfortunately, since we've been in the 1970s, 1980s,
since we got off the gold standard.
Yeah, we've been printing a lot of money. We've been borrowing money from the rest of the world. We've had a consumer-based economy that's created this gigantic mess.
Yeah. The only thing that I think Peter and I actually agree on is I don't think lower interest rates are going to move us forward. And the reason I say that is the reason lower interest rates usually move you forward is it encourages you and me to borrow. And we don't have a problem with people wanting to borrow right now. What we have is a problem with people wanting to lend. And I don't think lower interest rates is going to get us what we've gotten in the past.
Okay, we'll hold off on that for the moment. Thanks to our panel.
For them. All right, well, our oil is trading now at lower levels, as I said, down more than $1 today.
And some analysts expecting prices at the pump will follow. The big question is when. I know that's what you all want to know. Is it in OPEC's best interests, though, to keep gas prices around $3 per gallon, or higher, or lower? Our Fox panel back now to talk about that. Gary Kaltbaum, it seems pretty evident that OPEC absolutely loves gasoline at higher prices. However, it tends to bite them when it gets higher than that. What do you think that OPEC's thinking right now about gas prices?
Well, look, OPEC is a business, and they love big profit margins, and that's what they are getting, fixed costs to bring the oil out, and oil prices going up. I think the big secret, though, is OPEC has no control of oil prices anymore. In the past, they've tried to raise production, nothing happened. They tried to lower production, nothing happened. But they are a business, and they want prices to stay up as possible, but not too much, because if you get a worldwide economic slowdown, it will affect oil going forward. By the way, December 16th at 2 p.m., 25-cent drop in gas prices across the country, and I will guarantee you that.
Wait a minute. How do you know? What's your info?
Oh, I don't know. It's a good date, but there is no doubt a good 25 cents in some areas, maybe 30, 35 cents.
All right. Well,
December
Victoria,
16th.
OPEC, they used to try to make deals to try to keep production down or increase production. It never worked. They're trying it again. Will it work now?
Well, they're trying to respond to the marketplace. They're trying to keep their profits high at the same time. When people complain about high oil prices, they'll often say, oh, it's the speculators. It's not a question of the supply that we're putting on the market. Ultimately, though, if prices go too high, people will pull back. What amazes me is that we've seen such a rise in oil prices. I pay $50 at the pump to fill my Subaru, and folks haven't seemed to pull back. SUVs are still selling strong. The American consumer is, weaker than a year ago, but certainly not as weak as you would think, considering how high oil prices are.
Pat, do you think that because the price was inching up incrementally that people didn't feel it and got used to it and adjusted to the higher price?
Yeah, and I think that the average guy who couldn't afford it just put it on his credit card. And so he's just paying interest on that, and until he taps out, he's just going to keep going. The problem is there's not much of a change in demand when there's a change in price. I can't drive halfway to work, park my car, and hoof it the rest of the way just because they raised the price of gasoline. So what happens is in the short run, all we can do is eat the difference in price. In the long run, though, we can change anything. In the long run, I can buy a more fuel-efficient car. In the long run, I can move closer to work. There's a million things I can do in the long run. The short run is really where we run into the problem.
But Peter, as Victoria said, it's not changing people's buying habits as of yet. It hasn't really worked its way into the consciousness of America that we got to do something about it in terms of cutting back on oil.
Eventually it will. I mean, people have been putting these on credit cards, charging them against their home equity. But unfortunately, oil prices are going to go a lot higher from here. And it's not really oil that's getting more expensive. It's the dollars that we're using to pay for that oil that are losing value. And also, other currencies are being debased. Central banks around the world are printing a lot of money, and therefore oil prices have to rise. Otherwise, what we're asking OPEC to do is take a price cut to give us the same amount of oil for cheaper currency. You know, when I pointed out, on the show
Well, what's
before,
wrong with that?
Well, but they're not, it's great for
They
us.
deserve a price cut.
They're not going to do it. In the 1970s, oil went from $3 a barrel in 1970 to $30 a barrel in 1980. That was a tenfold increase, but that was because we debased our money. Because we created a lot of money in the 1960s, we debased the dollar. As a result, prices went up for everything, and that's what's happening. I mean, oil prices are going up
because it's a supply-demand. It's a basic economic equation. It's supply and demand. The worldwide demand for oil is going up. The supply is not going up. You have a dislocation of a basic economic
The demand
concept of
is the
supply and
inflation.
demand.
We're printing money. That's creating the demand.
Absolutely not. It's the units that are going up. The growth of China's units. China actually used to be self-sufficient when it came to oil.
But they also
now
produce more oil.
Normally, now they import oil, and the reason
Gary
they import
Kalfon,
oil is
last
because of
word.
the economy.
Look, Gary Kalfon, last word.
It goes back to one thing. There is a ton of oil around here, and nobody wants to take it out of the ground. I don't know what's going on. Anwar has billions of oil down there, and nothing to get done. Until that dynamic changes, we're up here in the trees.
That still just puts off the inevitable, Gary K., some people would say. I mean, at some point, Pat's prediction comes to pass. The people just get fed up and start buying cars that are more fuel efficient, the hybrids, etc.
Takes
Okay,
time.
thanks.
Where are they going to get the money?
Well, we'll talk about that in the next discussion. We've
Fox
got a lot more to
Business
come. For a lot of school boards and local governments, parking taxpayer cash in money market funds used to seem like a no-brainer, but that was before the subprime mortgage mess.
Our Shivani Joshi tells us now how towns and cities in Florida are scrambling to save their investments and explain what happened to their constituents. Last week, Shivani, we had on somebody who runs a fund in Florida. She pulled out this public money. There's a lot of teachers and other public employees. Quickly, as soon as she got a whiff of what was going on, and we're just wondering, what's the status now? What's going on in that area?
Well, the same is happening. It's not just happening in Florida. It's happening in Montana. It's happening in Connecticut. It's happening in Maine. It's happening all over the place. You're realizing that the fallout from the subprime mortgage mess is finding its way into different places, and now it's finding its way into municipalities in particular. Now, I want to talk about what these muni investment funds are. They're a good way for local governments, schools, fire departments to put their money in a place that earns more money in a safer way, in a liquid way, more so than they would get at a normal bank. So that's why
liquid meaning you can pull it out anytime.
at any time. And the reason they do this, it's like I said, it's liquid and it's used to fund everyday operating expenses, is used to pay for payroll, things of that nature. But what we're finding out is these investment funds actually have investments in SIVs that are backed by subprime mortgage debt. And when the defaults come in for this subprime mortgage debt, there's a shortfall in cash. And so what you're finding out in particular, like I spoke to someone in Jefferson County, quite literally having a difficult time paying their electricity bill at a school there in that county because they were using the funds from an investment fund to pay their bills every single day. So the impact of this is quite profound, and it's hitting us close to home where we thought we may not ever get hit by the subprime mortgage mess, right?
See, this is so important that you're bringing this more to light to our viewers, because a lot of people have no idea what their exposure is. They think, well, I never outright bought something like that, and they think their investments are safe, but in truth, it appears we're all exposed a lot more than we know.
Yeah, and that's the scary thing, is that it is hitting us closer to home. It's hitting us closer than most of us even thought. I mean, it's funny because even the most savvy financial people out there at the hedge funds and at the banks are falling prey to this. Now, just everyday Americans and municipalities and schools and fire departments and everyone across the board in municipalities are also
Well,
falling
the
prey to
scary
this
thing
as well.
is even the most liquid, as you say, counts, meaning stuff that you assume was safe. If you can pull the money out, that doesn't mean it had any exposure to subprime instruments or these exotic financial instruments.
And you make a good point. I mean, there are very strict rules about what municipalities can invest in, and it's usually across the board investment grade debt only. And on the face, all of these things seem to be, the SIVs seem to hold investment grade debt. So it wasn't like these municipalities were doing anything out of the ordinary, were not following the rules, because they actually were playing by the rules, but they just got burned because of the complexity of these investment vehicles. So that is the tricky thing. One thing I want to note is that Florida had frozen the assets. You mentioned the woman who was concerned about this. A lot of people, a lot of investors in Florida withdrew. In particular, $27 billion at the end of September in this Florida investment fund. Last week, there was $14 billion. They froze withdrawals in this investment fund. Today, we heard that they are going to reopen withdrawals because, like I said, people don't have money to pay their electric bills. They need access to this cash. They're going to be able to get access to it. But the challenge is, where's the shortfall going to come from? Is it going to be from taxpayers? There was a proposal to make the Florida pension fund foot the bill. That has not been widely accepted.
Now, we don't want to scare folks out there.
Right.
Now, not everybody lost a lot of cash.
Right.
This woman, for example, pulled her money out before they lost any of the principal that was put in. They may have lost a little bit of the profit that they made over the past year, but the principal was safe.
Correct. And again, we're talking about $27 billion of that $2 billion. It's a tenth of it's a tenth, right? It's a tenth there that could be at risk in structured investment vehicles. Not everything across the board is at risk. You make a good point. We have to put a caveat on there because it is not, at the end of the day, not everything is at risk. And your money is safe at the end of the day. And the states did provide some sort of assurance. So it's not like taxpayers will be footing the bill.
Shabani, thank you very much. But when she talks about people pulling their money out, governments, municipalities, school boards pulling money out of funds that are vulnerable to the subprime mortgage mess, that's called a run on the fund or a run on the bank. Everybody runs in, tries to pull the money out. It happened in London. Could the American public be next to get nervous and make a run on banks?
Could we ever see scenes like this when citizens of the UK lined up to take their money out of Northern Rock? It was only a couple of weeks ago because they thought the bank might go belly up. That's called a run on a bank. Will there be runs on U.S. banks like there were back in the Depression? We use the D word. Our Fox panel is here now to give us their thoughts. Pat Powell, we're a long way from the D word.
Right.
We're not even sure we could use the R word, recession.
Right. Yeah, this is so improbable. No one ever wants to say never, but this is so improbable. The probability of a run on our banks, resembling what you're seeing in Britain, is approaching zero. The reason is we have FDIC insurance, and those are individuals lining up. But if I were a corporate treasurer for a major Fortune 500 company, I'd be checking out the banks that I'm running my billions of dollars through. So it's really going to be a corporate event, and you might see some corporations changing banks because they're uninsured. But the average guy out there, he does not have more than $100,000 in a single institution.
Peter, what do you think?
Well, certainly, on these structured investment vehicles, one of the problems with them, it's very easy for Wall Street to put a number on a brokerage statement and send it out in the mail. But when people actually ask for their money back, they actually have to sell this stuff. And that's when you find out what it's really worth. And the people who were investing in these things, they got higher yields for a reason. It was because they were taking a lot of risk. They might not have appreciated it because they trusted Moody's and S&P that these ratings were legitimate, but they weren't. But as far as banks, will there be a run on the banks? Maybe. I don't, put much stock in the FDIC. And the other problem is, even if the government makes good on these deposits, what are they going to be worth? People might want to have a run on the bank because they want to get their money so they can convert it to another currency before it loses its value.
By the way, you mentioned Moody's and S&P. We do have the CEO of McGraw-Hill coming up in the show. McGraw-Hill, of course, is the parent company of Standard & Poor's, and we will talk to him about the ratings process, what went wrong, what stopgaps are in place now to make sure that doesn't happen again, because they rate the stuff and people look at it and say, oh, it's rated, okay, I can invest in it.
It's going to be a very interesting interview. Victoria, if I have what I think to be a completely safe account, some money market account, but it's making a lot more percentage-wise than, say, a Treasury bill, say it's making 5-6% interest, should I be somewhat suspicious of this fund?
Oh, gosh, that's a tough question because some money market funds came out with news that they were exposed to subprime, which just seems completely wrong. And it's just a function of the complexity of our financial systems. By the way, is it illegal?
Does it go against their charter to invest in these strange instruments?
Well, I don't think they knew what they were investing in. These guys were buying bundles of mortgages, bundles of asset-backed securities, and they didn't necessarily know that they were buying subprime assets versus, prime assets. So, we probably will see some lawsuits if that's what you're asking, but I don't think it's particularly illegal. Folks have to be very careful. The scary thing about a run on the bank, as Peter was saying, it's kind of a self-fulfilling prophecy. All of a sudden, banks have to give you cash and go and liquidate some of the investments that they've made. And if everyone does that, or lots of banks do that at once, it's a really scary situation. What concerns me, too, and this is an important point, is just that information travels so quickly in our society. Folks are on the web all the time. So I think we're particularly sensitive to news and likely to get it very quickly.
We should also make the point that you know, now you've got some very smart money people, so the so-called fast money like Wilbur Ross, the big financier, and Virgin Money, Richard Branson, making a play for Northern Rock. There's always a yin to the yang there. There's a way to make money when there's a way to lose money. But Gary Kaltbaum, is it absolutely outrageous that we're even talking about things that used to be the highlights of the AT&T commercials, of people waiting in line, you know, the old commercials where you saw the old Depression video? Is that ridiculous to even be discussing at this point?
You know, Liz, it's not fun to discuss these things, but I have to tell you, I think it's quite important that we do. And the reason being is, you know, when you're dealing with people's money, you're dealing with emotion. People are very emotional about it, and it tends to feed on itself. And something Victoria said is 100% right. Communication is now lightning fast, and you get it on the web, and it tends to feed on itself. And when it comes to what happened in Florida, you got to remember, the people making decisions, big word behind these people, it's called fiduciary. They have a responsibility to make sure where they place the money that one penny is not lost. There was a quote that I read from one person that said, I cannot afford to have one dime out of this account, and that's why they pulled about $13 billion. So will it happen? I don't think banks will ever get in trouble, but certainly we can see something like that. We saw a little bit of that in Countrywide just a few weeks ago when people mixed up the bank versus the lending business.
True. All right. Well, that'll end this discussion for the moment. Thanks to our panel.
Well, here it comes. Debt number 2, credit card company executives on the hot seat on Capitol Hill. Hi, everybody. I'm David Asman.
And I'm Liz Clayman. Should the government pile on more regulations onto credit card companies, or should consumers be more responsible and take the heat that they get themselves trouble into? Well, we have a report from Washington, plus our Fox panel weighing in on that just ahead.
That's going to be exciting. I look forward to that one. First, to checking the markets, the Dow Jones Industrial Average is down about 27 points as you're looking at the NASDAQ, which is down percentage-wise a little bit more, although it has improved just a bit from where it was earlier.
Yeah, and you know, as you look at all of the indices, particularly the S&P, the Russell, they're down about 1/3 to 3/4%. And we saw some red on the screen in Europe before that market closed. The CAC 40, the DAX, the FTSE 100, London, France, Germany.
I love FTSE 100. I love that
FTSE,
name.
yeah, the financial, you know, whatever.
Yeah, well, financials, as Ben Stein would say, you know, financials. That's what's bringing the market down today.
Indeed. And we do have crude oil closing down, and we have it trading in the after-hours market down $1.14. So oil going down, gold going up, markets flailing. We begin our coverage of the markets with Robert Gray in the newsroom. Robert.
Yeah, and we track the financials because that's where the money is, I guess, guys. Hey, well, a little roller coaster afternoon maybe for some of us, including those of us in the newsroom. But take a look at your brokers there. A lot of concern about the broker-dealers. Remember, their quarter ended on Friday. J.P. Morgan out today cutting estimates for that fiscal fourth quarter and for all of 2008, looking at weaker fixed income projections, modest slowdown in the advisory revenue growth. I mean, we've seen a big slowdown in M&A activity. The brakes have really been put on with the credit crunch, and so they won't be getting the lucrative fees that they generally get for that. Haven't seen a lot of IPOs come into market either, the underwriting fees there as well, and so you're seeing these stocks particularly under pressure today. Merrill Lynch, one of the worst performers in the Fox 50 today, down 3.5%. Punks Eagle analyst Dick Bove going a step further. He said, you know what, his recent upgrades of some of these names were premature. He's doing an about face now, downgrading the likes of Goldman Sachs and Lehman Brothers, Bear Stearns, all to a sell rating from a market perform. And over at Deutsche Bank, they're cutting their estimates for profit by an average of 10% for the group. So a lot of pressure on the broker-dealers today, and they are sending the group lower. And we've seen some of the other bank stocks moving lower today. Washington Mutual just took a look down about 5% today. Lehman Brothers, some news out of it also. It's moving onto the floor of the NYSE as one of the specialists there. It'll be the number 4 specialist firm on the big board, and it's going to take over Vandermeulen, the Dutch company's market-making role there on the floor of the big board, basically getting it for free. Vandermeulen saying, you know what, it's just going to take a write-down for this, and Lehman Specialist Book's going to include 3 of the Dow 30 stocks, also 44 members of the S&P 500. So Vandermeulen stock was at its lowest level since going public back in September, as they've seen their market share dwindling down to about 5% there for specialists. A lot more of that trading going electronic there. Also did want to take a quick look actually at Freddie Mac, talking about the index of home prices. More disappointing news for home prices, falling 1.3% in the third quarter. That's the sharpest decline in 25 years, Freddie Mac reporting today. So we are seeing the home prices continuing to fall, and we're seeing the home builders continuing to fall as well. Look at some of those losses, 5% for Beazer Homes. So a lot of news focusing on financials and housing. And guys, we've talked about this trend before. When that's the case, generally we see the market weak.
Semiconductors are higher.
They are higher.
There you go.
And the transports are still rocking. They're still rolling higher.
All right. Well, as you can see, the Dow is down 37, NASDAQ down about 10, S&P about 6 points.
Let's break it all down from the source. Tracy Burns, she's on the floor of the New York Stock Exchange. Hi, Tracy.
Hey, Liz, how are you guys doing? It is good. It's nice and quiet down here, and that's actually really good news. You know, I was just talking to someone before. We had that huge run-up last week, and we didn't give it all back, and that's actually somewhat comforting that we're kind of holding at these levels. You know, we're waiting for a lot of information. We have same-store sales numbers on Thursday. We have the jobs number Friday, and of course we have Uncle Ben reporting next week. So everyone is kind of waiting. There's been no real reason to put any new money in, but at the same time, people aren't pulling money out, which is a very good thing. Of course, you know, there's more stocks down than up today, but I think this is all to be expected at this point. We talked earlier about the solar stocks being up, and that's because they're waiting for Congress. You know, there's rumors that Congress is going to approve this energy bill that focuses on alternative energy. So all the solar stocks are doing very, very well today. LDK Solar, Trina Solar are all on the New York Stock Exchange, and they're rocking because of it. Robert alluded to or talked about all the financials doing horrible. And, you know, and he talked about Lehman's deal down here, and it actually puts Lehman in a pretty sweet spot. They'll be the fourth largest specialist down here, representing over 400 stocks. So it's a decent move, and it also says something about the fact that they still have faith in human beings trading down here, and the specialists doing a job that an electronic machine can't do. And I think that sends a really good signal, too. So for now, we're hanging, we're watching, and we're fingers crossed we're not going to close down too much. Liz, David, back to you guys.
Tracy, thank you. Fox Business Alert, Congress calls another group of lenders to the Hill. This time, it's not the subprime mortgage lenders, it's credit card company executives.
Just when you thought you could see the light at the end of one tunnel, we get you into another tunnel. Well, critics accusing them of jacking up rates, even on people who pay their bills on time. Is it unfair or just smart business? Rich Edson has more from Washington. Rich?
Well, David, executives from Discover, Bank of America, and Capital One all here on Capitol Hill today for a little term called risk-based pricing. What that is, essentially, if you have a credit card and you have outstanding debt, and even though you may pay that debt, every month the minimum balance, which your credit card sends you and asks you to pay, you may see a rate increase or an interest rate increase because your FICO score or any type of indicator has gone down because you've missed a bill doing something else or you're late paying another type of bill. Well, that, of course, as we just said, is called risk-based pricing. It's somewhat common in the credit card industry, and consumers and senators say that needs to change.
America needs to know what they're getting into in clear language. And it shouldn't be hard for a consumer to find out why they're paying what they're paying, when they're paying what they're paying, and how long it's going to take for them to get out of the hole if they're paying what they're being asked to pay.
I think in simple terms, the information is not that complicated that most people couldn't understand what the credit card companies were saying, but I think it's deliberately misleading and confusing, so you don't really get what they're telling you.
Now, card executives argue that, very simply, they're taking a risk. Every time you make a purchase with a credit card, they are extending you new credit, and they're taking a risk loaning you that money. And if you are deemed as a greater risk because you're missing out on payments elsewhere, or your FICO score is less from what it was a month ago, that they should be able to raise those interest rates because of your increased risk. Now, senators and reps are looking into perhaps changing it. Of course, they disagree with those credit card companies. Carl Levin clearly does. He called the hearing, and he's also called for some legislation. One one point of his legislation would prevent those increases. In exceptive cases, of course, if you have an introductory rate or you have some sort of agreement with a credit card company that you will eventually have an increased credit rate. There are some other things going on. The Fed, of course, as you know, is asking credit card companies to give folks at least a 45-day notice if they are going to raise it. So not saying that there's a problem with raising it, but just be a little more transparent and at least give them that 45-day window if you're going to raise interest rates. Back to you.
So much thanks, Rich. So much of the criticism of the lending industry right now, but the fact remains these companies do help Americans buy their homes, their cars, finance college, sometimes start businesses.
So the question is, credit in America, is this a force for good or evil? Let's throw this one to our Fox panel. And Pat Powell, why don't you take it first? Credit cards. A lot of people use them. And
I hate them.
Really?
I absolutely hate them. I do think they're evil. And I do. But I think,
Dave Ramsey will love you for
but
that.
I think in this regard, Congress needs to blame themselves, because when they changed the bankruptcy law in 2005, meaning you could not wipe out your bad debts if you went into bankruptcy, you were going to carry them out of bankruptcy with you. What they did is they created brain-dead lending with the credit card companies. And so credit card companies, brain-dead lending, they don't have to think about it because they can just keep raising the rates, and you're never going to get rid of this. You know, I've seen credit cards that are up to 30% because some poor schlub had a problem and couldn't make a payment on time. He gets hit with a $39 fee, and he gets his credit card interest up to 30%. He will never pay that off. Congress has to do something about it.
Peter?
Well, you know, I agree. I mean, I think credit card or consumer debt in general is a cancer in a free market economy. I mean, you don't want people borrowing money to consume. You want savings to be made available to businesses and entrepreneurs to make capital investments, because that increases economic growth in the long run. And when you borrow money to invest, the investment has a return and it enables the business to repay the loan. But if someone borrows money to buy a television set or take a vacation, there's no asset, there's no income that they acquire. They can only repay the debt out of diminished future consumption. So we're basically sowing the seeds of our own demise when we borrow to consume.
But Victoria, I had a person on Scoreboard, this wonderful, sweet grandmother who started a business that became very successful. She went to the banks to get money to start the business. They wouldn't give her a loan. She maxed out on her credit cards to get enough cash to start the business, and a big success. So sometimes it works.
Right, but that's an investment, right? You're not just using your credit card, as Peter said, to go buy, you know, a great flat screen TV. Not all debt is created equal, and I think the consumption debt, when you just take out a credit card to buy something that you want today and not tomorrow, I think that is so dangerous. You know what I did a couple months ago that felt so good was I shredded all of these credit cards and called to cancel them. I had about 10 credit cards that I never used. You know, for Macy's, I signed up to get 15% off. And that affects your credit score. If you have lots of credit cards, that makes you a more risky customer in the eyes of lenders.
Victoria, do you have video of that, of you shredding those? That's the thing. People always talk about cutting up their cards, and, you know, to see it, Gary Kalpom,
shredding is more satisfying.
Shredding is very dramatic, but it comes to that point for some people. But David's point, credit cards have enabled certain people to reach certain goals in their life, and I'm wondering if there isn't a halfway midpoint where we could meet with the minds and come up with an idea that works, where people can responsibly use credit cards.
Well, Liz, it always comes back to individual responsibility. Unfortunately, there are a lot of people that live not paycheck to paycheck, but credit card to credit card. And that's something that has to be, look, that is the individual responsibility. But I have to tell you, a lot of these credit card companies, they're predators. They know you're behind. They'll send you a second credit card just to use for the first one, so you pay bigger fees. Now, as far as Congress getting into it, I have to tell you, for me, the bigger issue is full, fair, and timely disclosure when it comes to resetting rates and fees like that. And I have to tell you, Einstein and Stephen Hawking can't figure out the language. That's number one. And if they do, it's at the bottom of the statement, and then you need Superman vision to read that type of stuff. So I believe the credit cards are doing an injustice to the consumer by not showing everything out up front in bold letters.
Okay, but Pat Powell, I have been to countries in Latin America where they try to put limits on interest rates for certain credit institutions, whether it's credit cards or whatever. It fails miserably. When the government tries to put price controls, if you will, on credit, they fail just as badly as price controls on anything else.
Yeah, the problem is not the interest rate. The problem goes back to the bankruptcy law. If you allow people that have gotten so far over the line that they will never recover to declare bankruptcy and get a second chance, lenders will have to pay attention to who they give credit cards to, and they will have to lend responsibly. This was a 2005 change that was lobbied heavily by these same people who are now testifying before Congress and saying, not our fault.
Is Congress on the mark, Peter, by focusing on the credit card companies and saying, you guys are pulling some fast ones on consumers?
Well, I think, the basic problem goes back to similar to what we're having with subprime. The reason that there's such an aggressive market right now for credit card debt is because Wall Street's been buying it up and securitizing and selling it to the Chinese and the Saudis, just like they were with mortgage debt. Yeah, they're securitizing credit card debt. All this consumer debt is being repackaged by Wall Street, tranched up, sliced and diced, and sold around the world. And when these loans go bad, and the people realize that, we're not going to get paid back, just like the subprime mortgage crisis, we're not going to get paid, then the credit crisis is going to hit home, and people are going to stop.
Well, on that cheery note, it's we got to turn corners here.
President Bush.
Foreign buyers heading to the shores of the Sunshine State.
The weak dollar making U.S. real estate, particularly in Florida and elsewhere, red hot. People are snapping it up, those Canucks. They've got the strong loony. Phil Keating has more from Miami. Hi, Phil.
Hi, Liz and David. Yes, it's been a negative real estate slump story for most Americans, but growingly it's been more good news for people overseas, particularly in Europe. Pretty much every day you see a negative story here in the U.S., whether it's the prices for home resales that are continuing to decline, or it's a builder or developer filing for bankruptcy, or if it's the foreclosure issue, which yesterday the U.S. Treasury Secretary dealt with, hoping to next year keep those AMRs from going up for 1.5 million Americans. But what's been bad for the American investor and real estate owner has been a big bargain hunt for those over in Europe. Florida, the Sunshine State, actually ranks #1 when it comes to international buyers interested in real estate. Lately, there are more coming from Europe, British, Russian, Italians, on top of the typical interest we get from Canadians and Latin Americans. And in the Miami area especially, much of the real estate is being bought by foreigners on the high end, properties starting in the millions. Key reasons for all of this: low interest rates, plenty of supply, plenty of sunshine, location, 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 and of course the weak greenback.
Now the dollar is down, the euro is up. That means a big discount for foreign buyers from Europe and most other countries as well.
W Hotels is building a 400-unit condotel in South Beach. Property valued at about $500 million. It's scheduled to be completed next December, but already it's 70% sold, much of that to foreign buyers, like Italy's Fernando Placide. He says right now he can get a whole lot more for his money in the U.S. than at home in Rome. And Miami Beach, South Beach, also has other attractions.
For investment, the one important thing is the weak dollar. That for you as a European is very, very good.
And in Greater Miami, there is a glut of supply, or rather an abundance of supply. Roughly 50 to 80,000 properties are available in Miami-Dade and Broward counties, and right now in just the Miami area, about 20,000 condominiums are either being planned to be built or are currently under construction. And typically in Miami, they only sell about 1,000 condos a year. So there's a supply, and in Europe, they are finding the attractions in Miami. And what Fernando told me, he says, #1, it's a big U.S. city. It's got a Caribbean flavor and tropical feel and tons of beautiful women. That's what he was talking about, David. That's why you should always come visit me.
Well, I was going to say all of which interests Phil Keating as well, and for good reasons. Phil, good to see you, man.
Hey, Phil, thanks. The weak dollar, so might not be so bad, right? If it means that foreign buyers are swooping in to help us pull out of the subprime mortgage mess.
Let's talk to our Fox panel and see if they really think that's what's going on. I saw you shaking your head. No, Peter, why?
Well, I mean, if foreigners come over here and build factories, fine, that helps the economy. But when they just scoop our assets out from underneath us, when they take our weak dollars and recycle them and buy up our assets, buy our real estate, buy our companies, this is our country being bought out from under us.
But doesn't that happen all the time? I remember when the petrodollars did it in the 70s. I remember when the Japanese did it in the 80s. It's a cycle that we go through, and then they sell it back to Americans.
Unfortunately, though, this cycle is going to be very pronounced this time. This is the price we pay for years of living beyond our means. We're selling off our best assets, and these deals are going going to get a lot better for foreigners. The dollar's going a lot lower. Real estate's going a lot lower. They're going to buy all the premium
go
properties.
ahead, Gary.
Yeah.
Foreigners have been buying up our assets since the beginning of time.
No.
And that's what markets are all about. The dollar is weak, they come here. The dollar is strong, they stop. I know you have this whole thing that the end of the world is coming and we're the Titanic, but it's just not that bad. You know what I have to say to the foreigners? Come to Florida, baby. I've got a house in East Orlando. Come pick it up. Great place.
We used to buy up foreign assets. We were the world's wealthiest creditor nation. It was Americans taking our strong dollars and buying assets all over Europe.
But Pat, is that just waxing and waning in the way of the free market?
Absolutely. And when the dollar is strong, we do those kind of things. We go over and we are buying European assets, and they have the same trepidation when we come in and try and buy up their assets that we're having today when they're coming in to buy up our assets. You're absolutely right. It's the way that markets ebb and flow. And the weak dollar, this is one of the benefits of the weak dollar, is that we can attract these people here. It's not just the real estate market. It's also Canadians streaming across the border to buy all our goods.
But Victoria, you know, one fear that I do have about all this, part of what Peter's saying, is that it drives protectionist fever here in the United States. There's a lot of people see foreigners coming in and say, oh, my God, it's an invasion. We have to keep them out. They put up all these tariff barriers.
You can't tell the difference between Americans and Canadians.
Those accents.
What's that big accents, yeah.
I think that is a real risk. I think there's a huge political risk that we all get a little bit scared and we throw up the gates of protection, and that would be really negative for our economy. But Pat was onto something that's crucial, which is it's not just real estate. Foreigners are buying our goods and services right now. And in the last quarter, it looks like the growth in that, foreigners coming and buying goods and services that Americans produce, made up for the shortfall on how construction starts. Right? Because that's been slowing. But meanwhile, because the dollar's weak, you see more foreigners coming into the U.S. and buying our goods and services. That's a crucial kind of balancing act that's going on right now, and it's why we want foreigners to be buying stuff in the U.S., housing and other.
Well, you know that the Canadians will really have a toehold when they demand a hockey team in Fort Lauderdale or something. How can that be a bad thing, Peter, if what would have been left as an empty house that was causing all kinds of problems is now picked up by a Canadian who comes to visit and spends their money here, and
but
you know, the service industry, it's a domino effect.
If the dollar hadn't collapsed, it would have been picked up by an American, and we would own that asset. It's not a good thing when our assets end up being owned by
Peter,
foreigners.
we've got a housing glut.
The dollar.
That's why.
The dollar has been going down, but go get a 10 to 15-year chart of the dollar index. It's just down half of what we made before that.
There are a lot of people. There are a lot of people living up here in New York that don't have condos in Florida that are cold this winter that would probably like to go down there, but now they can't because the Canadians are buying them instead.
I assure you, they could still go down and pick up a condo. Gary,
they can't afford it. Their money's too cheap.
Is there not a condo down there for an American to go buy?
You can't afford it.
I believe there are zero barriers to entry for Irish, Canadian, Americans, Smirks. It does not matter to me.
How about no down payment and they can't afford the mortgage?
By the way, Gary, just quickly, because you are down there and you'll be a reporter as well, 2-bedroom with a view of the water. How much is that condo going for down there?
About $1.99.
Seriously, how much?
Well, let's just say that they're down about, from what I know, especially in Miami, 25–30%. But my opinion, in the next couple of years, it could be name your price because they can't get rid of the product, and they're building 20,000 more. These people are insane down there.
Thank you very much.
Gary.
Into our panel.
We are keeping an eye on. 9 minutes away from the closing bell. So glad you're watching it with us. The stock market slipping lower, moving into the final minutes. Dow Jones Industrials down 66 points. And I have to tell you, I was watching for a while there. The Morgan Stanley Healthcare Index was up, and the semiconductors and the Philadelphia Semiconductor Index were higher. Now it's just the SOX index, and pretty much most of this is a broad-based move to the downside, but the volume's not massive.
Volume's not massive, although there is an emphasis in the downside within the financial sector. You might remember Goldman Sachs was one of those financials that seemed to be somewhat immune from what was happening to all the others. Well, no more. It's down about 5% today. There are some concerns about its exposure to the subprime mess.
Yeah, even though, and you heard it here from Hank Greenberg, formerly of AIG and now of Star Company, He said that Goldman played this pretty well, at least from
Yeah.
the surface of it.
Yeah. Well, he should know. He has some of that stock. He's also a huge stockholder in other companies that have subprime mortgages. Of course, what we're finding out is just about every stock that you can buy has some exposure to it. Just about everybody's
Exactly.
into it. Well, what happened? Our Fox Business panel begins with Tracy Burns at the New York Stock Exchange and tell us what happened, at least in today's market. You don't have to take on the whole subprime mess, Tracy. Just
Not
today's
today, at
marketplace.
least. Not today. You can get back to me on that, though, that's for sure. Well, today, actually, I mean, I think overall everyone's pretty happy with what happened. You know, we had this run-up last week. Everyone wants to make sure we don't give it all back, and we held on. I mean, down 68 points, it's not terrible. The financials, no surprise, brought us back down again. You know, J.P. Morgan came out a little late than never, if you ask me, but downgraded again the big banks, and they came down. And so they pulled the market down. On the upside, though, we had the flight to quality stocks doing really well, you know, like the Reynolds, the Altria. You know, the tobacco stocks are up 30% for the year. I hate to say that people are making money off of those little cigarettes out there, even though that's not what anybody wants to hear. But people are smoking, and we're making money off of them. But for the most part, we're waiting on economic news. We're waiting on OPEC. OPEC's meeting on Wednesday. We're waiting on same-store sales numbers, Friday's jobs number, and the Fed next week. So I think we're going to see a lot of this wait and see. People have no real reason to put money in right now. The good news, though, is that they're not pulling their money out. So that, I think, is a good way to end the day. Liz, David, back to you guys.
Tracy, thank you. Peter Schiff, what do you think? I mean, we've had a day where there didn't seem to be very exciting trading, at least to the upside. And once again, the financials, very sensitive to any kind of perception that the subprime fallout has not entirely fallen out.
I mean, the financials are going to lead the market lower. And, you know, unfortunately, a lot of companies that aren't in the financial industry earn a lot of their money through financial services. A big percentage of the S&P earnings comes from finance, and the earnings are going to continue to falter. So you're going to see weakness in the financials, in the home builders, in the retailers. The only bright spots, if you want to call them bright spots, are going to be export-oriented businesses. You know, you just mentioned tobacco. I mean, one of the reasons tobacco is doing so well is we sell a lot of tobacco products abroad. They smoke a lot more in Asia and Europe than we do here, and so you know, the weak dollar, we're exporting more cigarettes.
It's also because you look at these write-downs and you say, I need a cigarette, Pat.
Well, that's true. And, you know, people do not give up smoking and when they raise the price of a pack of cigarettes because they're addicted to it. So it makes sense that even in a market which would be difficult, people are still going to smoke and they're still going to be buying their cigarettes. I think there aren't a lot of compelling reasons to get people off the sidelines in here to buy yet. And I think that it's going to be a sort of a sloppy market as we sort of drudge our way through to the end of the year. So I don't think today is going to be that unusual a period. I hate, though, to get into that short-term, like, pessimism. Because
we're still way over 13,000, 13,255.
You know, and I remember back in July when we crossed 14,000 for the first time, and I remember all the enthusiasm with the people I was on the air with. I think I was the only one that said markets go down as well as up. Sure. So I wouldn't worry too much about this.
Gary Kaltbaum, what are you optimistic about?
It's my son's birthday this weekend.
Oh, happy birthday.
We're going to have a big party. Look, overall, I think the economy is in a big slowdown, but I am not calling for the Titanic like Peter is. And I think there's a lot of things that have to be worked out. But I just want to pinpoint something, and David said something here that's real important. Goldman Sachs today is acting like Michael Vick's football career right now. And if Goldman Sachs, after saying everything is fine, beautiful, lovely, and they're immune, coughs one up like Merrill Lynch, that's your next big leg down. And I also want to add General Electric is starting to act a little bit like that also. And you know how many loans they're on? They're basically a financial company these days. So These are two very important things to watch right now.
Victoria, go ahead.
Well, I'm going to echo a little bit what Peter was talking about earlier. It's an important point, and that is that a lot of companies that you don't think of as lenders are lending out money to finance purchases. Harley-Davidson is one of these. We mentioned this in the current issue of Forbes, where 13% of their profits are coming from lending out monies to folks to buy motorcycles, and they're seeing their defaults rise, delinquent loans. So I still think we're in the stage where the market's going to be so rocky. You know, instead of a cigarette, grab some Dramamine because it's
lots of
it's going to be pretty nauseating.
Yeah, a lot of it. All right, thanks to our panel. The closing bell is just around the corner. Here's what's happening in the final minutes of trading. The Dow is down 61 points. We will be right back.